With rising costs of living and wages not keeping up with inflation, more people than ever are taking on a second job or starting a side hustle business just to get by. But your additional income could be at the risk of being taxed. In this video, I will explain what trading income is, how it is taxed, and strategies that you can implement today to pay less tax on your trading income to HMRC. Hi, I'm Sabina. I'm a chartered certified accountant with diverse experience gained at one of the top UK accountancy firms and in the industry. On this channel, I share knowledge and strategies about finance, entrepreneurship, and self-development to help you achieve your financial goals and build a life you truly love. If that's something you are interested in and would like to learn more about, then please subscribe to my channel. Number 1. What is trading income? There are two ways that you can earn trading income without realizing that you have to declare it to HMRC and pay tax on. The first way is selling goods. This is when you earn income from selling items on a regular basis, for example, online or car boot sales. This includes items that you bought with intention of selling for profit, for example, personalized t-shirts, candles, or natural ingredients skincare products. Items that you made to sell for profit, for example, digital products like ebooks, templates, online courses, or physical products, and commission that you earn from selling goods for other people. The second way is providing services. This is when you earn income from providing services that you are paid for. For example, video editor, social media manager, or personal trainer. This includes casual jobs like driving Uber, dog walking, or gardening. This also includes charging other people for using your tools or equipment. Selling goods or providing services are good ways of earning additional income, but your trading income could be at the risk of being taxed if you exceed tax-free allowances available for trading income. In addition, this extra income could increase your total taxable income and push you into higher or additional tax bands. Number 2, tax on trading income. Trading income is taxed at your usual rate of income tax, which are 0% for up to £12,570, 20% for up to £50,270, 40% for up to £125,140, and 45% over £125,140. As people earn more from their multiple jobs or side hustles, whilst the tax bands are frozen, more people will end up being tipped over into those higher or additional tax bands. This is effectively a stealth tax because it results from something called fiscal drags. By keeping thresholds at the same level, whilst your salary increases, you will be pushed into paying tax at higher rates of 40% and 45%. And if you do not pay any tax at the minute because your income is below £12,570, it is likely that you will be pushed into paying tax at 20% for the first time as your income exceeds the personal allowance. But there are things that you can do to protect your trading income from being taxed. Let's have a look at those. Number 4. Strategies to pay less tax on your trading income. There are some allowances available for trading income before you have to pay tax. First allowance is the trading allowance, which lets you earn £1,000 tax-free. This means that if you earn £1,000 from doing casual jobs or selling things online, you do not have to tell HMRC or declare that income in your tax return. But if you earn more than £1,000, you must register for self-assessment and declare that income in your self-assessment tax return. Second allowance is the personal allowance of £12,570, which is the amount of income that you can earn tax-free. That's been frozen until the 2030-2031 tax year. That means that if you haven't exceeded £12,570 with your salary, pension, or other income, it can be used to shelter your trading income from tax. In the current economic environment, with rising costs of living and wages not keeping up with inflation, more people take on a second job or start a side hustle business to earn some additional income. Because of that, a lot of people won't have any of their personal allowance left and will only have £1,000 of the trading allowance available to use. The second strategy is to deduct allowable expenses. You can pay less tax on your trading income if you claim allowable expenses which are deducted from your trading income and you are only taxed on your profits. These are things that you need to spend money on in the day-to-day running of your business anyway. For example, tax-deductible expenses are office costs, for example, stationery or phone bill, costs of your business premises, for example, lighting or heating, travel costs, costs of buying things to sell on, insurance, accounting, website costs. But you cannot claim expenses if you use £1,000 tax-free trading allowance. It's really important that you are organized and keep records of all expenses that you've been incurring throughout the year. So when it comes to completing and submitting your tax return, you are not underclaiming on those expenses that you've paid for in relation to your business. If you use something for both personal and business reasons, you can only claim allowable expenses of the business costs. And if you are not sure which costs you can actually deduct in your tax return, then make sure you consult your own tax advisor. Let's have a look at the example. Let's say your business is to sell t-shirts online. You sell your t-shirts for £100 and you purchase them for £40. And let's say you sold 30 items in a year. Your turnover or gross income is £3,000, which is 30 t-shirts times £100. Then you can deduct trading allowance of £1,000 or allowable business expenses, which are £1,200, which is 30 t-shirts times £40. In this example, your allowable expenses of 1,200 are higher than your trading allowance of £1,000, so it's more tax efficient to claim your business expenses. Your trading profit is 1,800, which is £3,000 of your turnover less £1,200 of your expenses. If that's the only income you earn in a tax year, then that is covered by your personal allowance and you don't have to pay any tax on it. But let's say that you also earn £20,000 in wages in the tax year. Your total taxable income is £21,800. That is your trading profit 1,800 plus your wages £20,000. Now you can deduct your personal allowance, which is £12,570, and your taxable income is £9,230. That falls within a basic rate tax band, so you will pay tax at 20%. your income tax will be £1,846, which is £9,230 of your taxable income times 20%. The third strategy is to claim capital allowances. Capital allowances are a type of tax relief that lets you deduct some or all of the value of your business assets from your trading profits before paying tax. Business assets are things that provide long-term value to your business, and you will use it for more than 1 year. For example, if you are a video editor, you will need a laptop or a desk to work. And if you are a gardener, you will need tools, equipment, machinery, or a van to work. Most business assets will qualify for the annual investment allowance, which is a type of capital allowances, which means that you can deduct total cost of the qualifying assets up to £1 million. This is a very generous tax relief than it used to be and often underclaimed. You cannot claim capital allowances if you use £1,000 of your tax-free trading allowance. So far, we've been talking about earning trading income as a sole trader, but there are other ways you can set up your business to pay less tax. One alternative is a limited company, which is more complex business structure than a sole trader. However, if you are a higher or additional rate taxpayer, that could work out more tax efficient because corporation tax rates are lower than income tax rates, and they range from 19% to 25%, whereas the income tax rates for higher and additional rate taxpayer are 40% and 45%. If you are not sure which business structure is best for you, then make sure that you consult your own tax advisor. If you found this video helpful, please let me know in the comments below, and I would appreciate if you subscribe to my channel. If you are not sure if you need to register for self-assessment or declare your trading income on a self-assessment tax return, then watch this video next. I will see you there.